This is going to take the concept of treasury stock to the intermediate accounting level, where we look at the different methods for recording repurchases. What is taught in accounting principles course is the basic cost method, which is the traditional treasury stock method, but companies have an option of using the PAR method, which is the retired stock method. It's just a different way of recording this. So stock repurchases, if it's treasury stock, this is viewed as a temporary reduction in shareholders' equity to be reversed later when the treasury stock is resold. So I purchase it, record it at my cost. It's no longer outstanding. It's just issued. And then later when I resell it, it becomes outstanding again. It's issued only, no longer outstanding. Now, retired stock, this is not viewed as temporary. This is viewed as permanent reduction in shareholders' equity. It's treated as if the stock was never issued in the first place. Now, treasury stock treatment remains out of old accounting tradition, and there are actually some states that no longer allow it. So it's going to depend on which state the corporation was incorporated, where they filed their initial corporate charter. Stock repurchases, no matter what method, it's viewed as a distribution of corporate assets to shareholders, and it can offset an increase in shares routinely issued to employees under any stock awards, stock options. Sometimes companies, instead of viewing it or calling it treasury stock, they treat it as if the stock is retired. So either way, they're purchasing it back. It just depends on the accounting treatment. Am I going to use the cost method, or am I going to use the PAR method? And why does this happen? Well, you may want to purchase more of your own stock because you want to distribute it. Distribute a stock dividend. Maybe you want to merge with another corporation. Or it could even be to defend against a hostile takeover. The key to remember is investment in your own stock is not an asset, although treasury stock does have the same normal balance as an asset. It is a contra equity. And again, it is thought as a distribution of profits without having to pay dividends. So looking at the differences, if I purchase treasury stock, I record it at its cost and I hold it to resell later. If I retire stock, I don't record it at cost. I record it at its par value. So whatever I paid over par value or under par value, could be. It's either treated as if it was never sold, so a gain or loss will occur up front, where with treasury stock, if I buy it and record it at cost and then sell it later at either more or less than I paid for it, I will have an actual gain or loss. But there's special rules about recording those gains and losses, and we'll talk about that in a later slide. Treasury stock, it's simply reported as a reduction in equity. So I'm going to show the original common stock paid in capital excess of par, and then I will have less or a subtraction for the amount of treasury stock, usually shown below the retained earnings line and the accumulated other comprehensive income. If it's retired, I'm not showing treasury stock on a separate line item. I'm simply going to reduce the existing number of shares that are shown in common stock. For treasury stock, I debit contra equity. For retired stock, I debit common shares and APIC for the reduction in equity. Net result at the end is the same. So now talking about the cost method or the PAR method. The primary difference will be the timing and recognition for any gain or loss on treasury stock transactions. Most companies now do the cost method only for treasury stock, although in some states, corporations could choose to still call it treasury stock and follow the PAR method. The PAR method actually is virtually obsolete for treasury stock, as 95% of all corporations do follow the cost method of accounting when buying back treasury stock. And actually, IFRS requires the cost method. They don't allow the PAR method. So treasury stock versus retired. For the cost method, I want you to think treasury stock. Treasury stock is the cost method. I record it at its original cost, so you're thinking historic cost. It has a debit balance. It's a contra equity debit balance, just like an asset. So if that helps to remember how you record it, whatever I paid for the treasury stock is the same as whatever I paid for the long-term asset. I record it at its cost. And again, it is the preferred method for most corporations in the U.S. The cost method is not allowed to be used for retirement, while in some states you can choose between the cost and the par method if you're going to call it treasury stock. Kind of a technicality there. So for the par method, instead of recording at its cost, if I buy it back, I record the common shares or the reduction in common shares at their par value, and then a corresponding reduction in any paid-in capital excess of par. So it's as if I'm reversing an entry. If I sell stock, I get cash, debit, and I credit common stock, paid-in capital excess of par. Or at some levels, in our intermediate accounting, we usually call this APIC, additional paid-in capital. So think of retiring as you're just reversing the entry. Cash goes out with a credit and you reduce common shares and paid-in capital excess of par. But I'm not calling it treasury stock if I'm treating it as if it's retired. And the par method is required for stock retirement. So this is just a memory tool. If you're thinking the cost method, that is treasury stock accounting. If you're thinking the par method, that is stock retirement accounting. You're buying it back as if it was never issued in the first place. Where with treasury stock, I'm buying it back temporarily. Maybe the market is down. I'm going to buy low and hopefully sell later high. So treasury stock is a temporary repurchase. Retired stock is a permanent repurchase. So looking at the differences, it's simply a timing difference for when the gain or loss will be recognized. Now, the key here is the important FASB rule. Even though you buy something at low and sell it high, you have a realized gain or loss, but you're not allowed to recognize it in income. You bypass the income statement. Instead of recording a gain or a loss on treasury stock repurchase or stock retirement, it has to go into a separate paid-in capital share repurchase account for gains. So the treasury stock method, the cost method, you record it at its cost at its time of repurchase, and then later when you resell it. If you sell it for more, you have a gain. If you sell it for less, you have a loss, but you are not allowed to call it that on the income statement. The gain or loss will be indirectly recorded through paid-in capital share repurchase account. If it's a gain, it's a credit. If it's a loss, it's a debit. But there is another key rule here. You are not allowed to have a negative balance in a contributed capital account, while you can have a negative balance in retained earnings, an earned capital account. So again, treasury stock sales are never recorded as a gain or loss to the income statement. We call that bypassing the income statement, although the end result would have been the same. Let's say I was allowed to record a gain on sale of treasury stock. What would happen at the end of the accounting period? I would close that to equity, to retained earnings. So again, to repeat, this is a very important FASB rule, and the reason for it is to prevent earnings management, to prevent the misleading the users of your financial statements. It's not really income if you have complete control when you're going to make the sale. So this is a way that in the past, before the rule was passed, some companies would manipulate their income. Maybe they needed to get to a certain income level for management bonuses, and they had some treasury stock, so they sold it at a gain to artificially inflate earnings to get their bonuses. Or the other way around, artificially recorded a loss to maybe get a bigger tax deduction. So again, this prevents the over or understatement of income. Treasury stock transactions will bypass the income statement when you resell them and you actually do incur a gain or a loss. Same rule for retired. So it goes directly to the balance sheet instead of the income statement first. So looking at an example, let's say I paid $15 for treasury stock. I recorded debit to treasury stock, credit to cash. Retired stock, this is the PAR method. So instead of recording it at treasury stock, cash goes out for 15, but I reduce common stock, I reduce APIC, and the remaining loss. So what this would have been if I initially issued it at 10 and then I retired it at 15, that is a loss, but I'm not allowed to show it on the income statement. It goes to retained earnings. Okay, now looking at treasury stock, if I buy it for 15 and sell it for 15, here is the entry. Now looking at the retired stock, I bought it for 15, I bought it back, but I recorded the loss up front. Treasury stock, the gain or loss is on the back end. Retired stock, gain or loss is on the front end. It's just a timing difference. So now we're looking at an example. Let's say some treasury stock was sold at 20, bought at 15, sold at 20. So you have a $5 gain, but I can't call it a gain. It goes into this PIC account, APIC account. Now, what if I sold treasury stock at 8, bought it at 15, sold it at 8? First, I have to, for that $7 loss, if I have $5 already sitting in the APIC account, I have to clear that out first, zero it out. I cannot have a negative balance in a contributed capital account, and that's what APIC is. Remember the classifications of equity. You have contributed capital and earned capital. So contributed capital is the capital stock. Earned capital is retained earnings, and some people call it a third category, but you can think of it as a fair value adjustment. That is the accumulated other comprehensive income. You reduce APIC first for stock repurchase to 0 first, and then reduce any remaining loss is debited to retained earnings, not a loss account. And then just looking at this with T accounts, buy it for 30, sell it for 25, then sell 10 more. Let's say that was my loss. I zero out APIC, and then the remaining 5 loss comes out of retained earnings. The key is you can never have a negative balance in a contributed capital account. Now, if you didn't have anything in the contributed capital account, everything would come out of retained earnings to record that loss. So this is just a review. Treasury stock, the gains or losses are recorded indirectly to equity on the resale, the back end of it. So I buy it at cost. If I sell it later for a gain or loss, that's on the back end. That's later. Retired stock, I record it using at par, not cost. So the gain or loss is recorded on the front end when I initially retire it. And I treat retired stock as if it was never issued in the first place. The ending number of outstanding shares is going to be the same, no matter what method you were using. Key to remember, treasury stock sales are never recorded a gain or loss to the income statement. I'm repeating it again because this is a very important FASB rule. An APIC, a contributed capital, can never have a debit balance. Now, while the PAR method is virtually obsolete for how treasury stock is accounted for, if you think of the retirement method for repurchases, and that's my dog squeaking his toy, repurchase the PAR method is easier to remember.